You are listening to Her Time to Retire, a podcast dedicated to helping women gain the knowledge, confidence, and support they need to achieve financial success and emotional fulfillment when planning for retirement. If you are ready to finally take charge of your financial life, then keep listening. Your hosts are Glenn Price and Jonathan Scott, founders of Keystone Financial Resources in Brentwood, Tennessee. Both men specialize in crafting individualized retirement plans for women and have a passion for helping women discover and achieve their retirement goals. Glenn is a husband and father of 4 who was taught early in life through his relationship with his grandmother how a woman can not only take charge of her own destiny, but also positively influence the lives of her family and friends that surround her. Jonathan, husband and father of 3, attributes his own success to the strong women in his life, including his wife Brooke and his mother Suzanne. Both men together want to help more women live out their dreams in retirement. As always, if you have retirement questions, their phone lines are open at 615-661-9554, or you can visit their website to browse information, view upcoming events, or subscribe to the Her Time to Retire weekly newsletter. Just visit www.keystonefinancialresources.com. Now relax and enjoy the conversation.
Welcome to the Her Time to Retire podcast, where we help women to learn how to take control of their finances and their destinies. I'm Jonathan Scott, and I'll be your host today. We'll be talking with our guest, Shawn Kaplan, here, and he's going to talk to us a little bit about refinancing mortgages and structuring debt. Now, Shawn's a senior loan officer at Legacy Mutual Mortgage in Franklin, and he served the Middle Tennessee market for more than 18 years as a residential loan officer. And frankly, he served me and my parents as well, right, Shawn?
Yes, sir.
And so during this time, Shawn's been honored to assist more than 5,000 families with home financing for more than $500 million in closed real estate transactions. And in his personal time, Shawn serves in several capacities, such as a nonprofit director for the Coffee Drop Project, as well as organizing and leading mission trips to Israel, along with his wife, Jennifer, and their 2 daughters. So Shawn's a pretty accomplished guy. We put a lot of trust in Shawn, and we are thankful to have you here today.
I'm very, very honored to be here today. Thank you for having me.
Well, Shawn, I wanted to have you here to do a podcast with us because you know about our focus with Her Time to Retire and the special attention that we are giving these ladies as we're bringing some really common issues to the forefront. We're helping a lot of ladies have really good insight in and around these issues, and we're helping them to build an arsenal of great contacts that they can trust to help them when they need to navigate these obstacles. And I want you to be one of those people that's in their arsenal that they can trust. So I know that you share a common mission to us in your personal story. And so I'd love for you to share that today. Just talk a little bit about your personal story and how that relates to your business today.
Well, as we discussed previously, and thank you for having me here to share it, when I was young, unfortunately, my dad passed when I was 6 years old. Very unexpectedly, he took his own life. And so I had a single mom. I had a 6-month-old sister.
Wow.
And we lived in Vermont, in a little town called Underhill near Stowe. And so really cold winters, lots of snow. And I do remember times, when we slept in my mom's car, moving from apartment that we got kicked out of. And so life was hard. It was really, really tough. And it's very vivid and it never goes away. And I remember, seeing my mother get turned down at the bank, having to ask people to borrow money. People take advantage of her, and which is where I think I generated my gift of discernment, especially when new men came into her life. Right. I would really check those guys out. And so for me and my job, it's easy because when I help people, especially somebody who has been widowed or is a single woman or a single mother, it's my duty and my obligation to help them out. Because I know there were people there that did help my mother, and then there were people that did not.
Right. Well, an obstacle we're seeing so much of right now is that ladies are calling us and they're saying, even after this COVID period especially, but they're saying, we need additional cash flow inside our households. And this is a very real issue to us. And they're not very confident in how to create this cash flow. And time again, we're looking at what they've got, we're assessing it, and we're finding some really easy ways for them to restructure some of the debt and to give them great additional cash flow inside. And we're having people call us back and say, oh my gosh, this has changed everything for me in my household. And so tell me a little bit about how you're doing that. I know you're encountering it as well.
That is literally the reaction. I mean, there would literally be, people that'll say, wow, I wish I would have met you 5 years ago. And it's no rocket science. I think the single greatest misconception right now around housing and mortgages and managing money is people are still treating their mortgage the way it was when interest rates were 8, 10, 12, and 14%, or the bank could call your note due and you lose your house in a week or 30 days. Well, now since we have the deed of trust, banks can't do that.
Right.
And money, as we know, is in the 2s and the 3s. It's never been more affordable, and it's fixed. So as you grow older, it's the greatest single opportunity to fix your household expenses, number one. But where I'm going with this is a lot of people think that if they just have a lower loan balance, then they'll have a lower payment, which is true. But then they still forget about all their other expenses. Or if they have to have a car, or they've got a pending credit card or other debts, what are the payments on those? And what people don't realize is they'll have a low mortgage payment or a paid off house, but they're carrying other debt. And the problem with that is they could be moving that debt back in a better alignment to a fixed mortgage with one payment that's even lower than the total of what all those other bills are.
Correct.
So it feels really good when I can take a woman who has lost her husband or somebody who has been divorced, and she says, I don't want to leave my home, but I don't want to take that big old payment. And we can show them how we can take those other payments, put it together into one lower payment total overall.
Right.
And they get to keep the home. So now they keep the home, and they're paying less than they were before he was there.
Right.
And
one of the things that is shocking to a lot of the listeners out there, and for the first time in my life, I'm making recommendations like this as a financial advisor. But I'll say, hey, take the 30-year mortgage and a fixed rate on it. The difference between the 15-year rate and the 30-year rate is only about 0.5% in between.
Absolutely.
And the freedom you get on that 30-year mortgage is amazing. So for the first time ever, I'm recommending to people, hey, with interest rates between 2 and 3%, take the 30-year fixed rate. And don't plan on paying it back over 30 years, but every payment that you make in addition to the required payment, that's going directly to principal.
Right.
So you can pay this mortgage off in 15 years. You can pay it off in 10 years if you want, but you've got the flexibility of what's required out of you being much lower.
Right.
And so that's creating additional cash flow inside that household almost instantly. And ladies, this is, if you're sitting in a mortgage that you've been in for 5, 6, 8 years and it's 4 to 5% interest, you are a prime candidate to refinance that on a 30-year fixed term right now. Interest rates have been lower. How long has it been since we've seen 2 and 3% rates?
I don't think I haven't seen rates this low. I think in the almost 20 years I've done loans.
Yeah.
These are the lowest.
Some of the lowest in history ever. And the interest rate only has one way to go, right?
Yeah, it can't go much lower.
Yeah.
But what you just said, that's the other part. So the first part is, fixing the expenses at the lowest rate that you possibly can. The second part is keeping yourself protected against future volatility. Do we think the world's going to become more of a safe place or more of a dangerous place? The fact of the matter is there's going to be more stuff we're going to have to deal with in the future. So if you stick yourself to a 15-year mortgage loan or a 10-year mortgage loan, then what happens is you have to make that payment every month. And in 2009, in the housing collapse, I had dozens and dozens and dozens of families come back and say, I need to go back to a 30-year and refinance. But some of them could, and unfortunately, a lot of them couldn't get out of that loan. So I like when they set up the mortgage for future volatility. And what's interesting is, like, I have dozens of clients right now we're helping out that I can think of this scenario. They're 4 or 5 years into the loan. They got a 4% rate. We refinance back to a 30, so they lose 4 years on that mortgage loan. They drop their payment by $300 a month. We go down to $275 or something, or 2.5. If they take that $300 a month, if I run the amortization calendar, which I do when I'm on the appointment with them,
right.
I'll show them. It'll show them that they'll pay the house off in like 21 years.
Wow.
So not only did they save $300 a month, they're now shortening their term also, and they're protecting themselves against future volatility. And again, all they're doing is taking that spread on the savings on the rate and moving it into principal position every month instead of it going to the lender.
Right.
And it's not as confusing as it needs to be, but I'm seeing people make terrible decisions with some of these other mortgage companies. And the greatest tragedy is some people just need to be told when not to refinance, and it doesn't make sense.
Exactly. And there will be those that it doesn't make sense for. The idea is, ladies, I know that you're listening, and some of you may be thinking, gosh, it sounds kind of complicated, or how do I figure those figures? The idea is that you find a professional that you can trust that can help you here. Yeah. It's really very simple. The concept is that a lower rate is going to help you have additional cash flow. Right. And it's okay to put a longer term with it. That doesn't mean that you're stuck with that term. That just means that you have the flexibility of being within that term. Yeah. And so it's really pivotal to have somebody on your side like Shawn that can help you weigh out the pros and cons of, is this a good decision for you? And that you can trust that if Shawn doesn't think that it's a good decision for you to refinance, he's going to look you in the eye and he's going to say, this isn't for you. You know what? This works well for some people's situation, but not for yours. And he's going to send you on your way.
It's a very simple process. I mean, what my clients are doing is they'll send me over a copy of their most recent mortgage statement. And what we're going to do is we're going to look at what the potential savings is. If that potential savings off that, and you're going to be in the home, in the next couple of years or more, then we'll say, well, let's go to the next step. It's as easy as that. And there's many statements I look at and I say, look, you're at a 3.5% right now. The savings monthly would not justify the cost. You don't need to let anybody talk you into a refinance. No mailers, no phone calls, no online, and it gives people that peace of mind and knowing, okay, I'm good no matter what I hear on the news right now.
Right.
And I would like to add the third thing I think it does is my mother's life would have been a lot easier if she just would have had $10,000 or $20,000 sitting aside in an emergency fund. But the problem was my mom always had to, take a nickel and turn it into a dime, and she did a good job at it. She worked 3 jobs. I'd go with her, but right now, people are having the opportunity to go ahead and not only refinance and save monthly, choose to pay the loan off quicker if they want, but they also, once they pay some of this debt off, they're taking $10,000, $20,000, $30,000, throwing it to the side, and they're still paying less than what they were paying in a certain situation, and they have more cash.
Yes.
Or some people have a lot of equity, and I'm telling them, wouldn't you rather just have a mortgage payment or a higher mortgage payment, but have a lot more money invested? And that's another way, but that third, building up your reserves and for future volatility is, I think, very, very important right now.
Absolutely. What are your thoughts, Shawn, on these reverse mortgages? A lot of ladies are calling in and they're saying, what do I think about a reverse mortgage? What's your thought on it?
I can't speak enough on them because I've never, done them or brought them on as a product. I do have clients that have used them. And from what I understand is, if you don't have anybody you want to really leave the home to, and you want a monthly draw, to come to you, it can be right in the right application like anything else. But I do see a lot of people that are being taken advantage of or put in them without it being the right scenario. There's many other alternatives that are way better. For example, you could take out for every $10,000, $10,000, your mortgage payment only changes about $40 a month. So you could take out $30,000, which is $120 more a month. And how long could you live off $30,000? Well, how long could you live off $90,000? Because some people, what they have is they have their retirement or their fixed income, and they're like, well, I just like another extra $1,000 or $2,000 a month.
Right.
And there's also home equity line of credit. There's different ways to get to the equity in a home without just giving your home on, to a reverse mortgage. So
yeah,
I would not probably be, inclined to advise it to somebody in my family or circle of friends.
And ladies, here's a thought. I had a lady call in about 2 weeks ago, and she said that she needed some extra cash flow in the house. She didn't have a lot to invest, but she had a paid-for home. Or she owed maybe $10,000 or $20,000 on a home that was worth $250,000, and she said she was thinking about doing a reverse mortgage to create the extra cash flow in her household. And I said, you're young. Why would you do that? Have you thought about what else you could do with that equity? And she said, no, I haven't given it a lot of thought. And I said, what would you think about a rental property? And she said, years ago people told me about rental properties, and I think it would be a really good idea. I've not owned one yet. And I said, well, one thought would be that you took an equity line with your home now, and that you looked out there for rental property nearby and possibly purchased a rental home with a down payment from your equity loan.
Yeah.
And then you can finance that rental home, actually get a permanent loan on the rental home, and the renter is going to pay that mortgage plus additional cash flow to you and the household. And so immediately, instead of looking at depleting the only asset that you have, solve your cash flow needs by creating additional assets in your portfolio.
Absolutely.
And so she said, I've never thought that way. And I said, this is why you need some help. People need to be speaking into you and saying, hey, don't deplete the only asset that you've got. Turn it around and create other assets with it and get that cash flow coming in.
It's just bad advice, and unfortunately, it's costing people not only hundreds of thousands of dollars, if not millions of dollars in some cases, but it's also robbing them of a certain quality of life that they could be having.
Right.
Like, not worrying about your finances all the time is not something I think that the ladies should have to be doing in their 50s and their 60s. They should be enjoying this, the second portion of their life.
Right.
My mother right now, she is 64. No, she's 65, and I'm 42. Mm-hmm. She's moving down here on November 1 from Vermont, finally. So I'm getting her down here.
We'll have to get our moms together.
Yeah, right? And so I want to make sure the ladies understand this, too. My mom can't qualify to get a mortgage right now. Her credit's okay, but she's always worked like cash jobs or taking care of the elderly. And so what I'm going to do is, a lot of people are not aware of this, is under an FHA loan program, as long as my mother's credit score is a 580 or above, we put that loan in her name, and I'm allowed to co-sign and not live in the property, and she only has to put 3.5% down.
Wow.
So now, instead of going, because she said, I can't find rent anywhere. And I said, well, I don't mind help signing on the note. I'm going to sign on it. She'll keep it for 3 to 5 years. We'll sell it, and maybe we'll split the profits then. And then she'll have enough money to go put down another place.
So there's a great option for people that are trying to help with being a caretaker.
Yeah, because a lot of people's, like my mother's income changed through COVID. And she's like, well, I'm not an elderly nurse anymore, but I want to move down there. So what do I do? So me co-signing helps out. Now, I have to have qualifying credit too.
Sure.
But back in the day, they used to call it the kiddie condo program, where it was the reverse, where parents could co-sign for somebody in college to own their first place. Yeah. So now it's our turn to help our parents
out.
How
most of those rules have reversed now, and it is our time to help out.
Absolutely.
So, and a lot of the ladies that tune in on these podcasts, that's their situation, Shawn. So we have a lot of ladies that are caretakers. And what's so funny is you think it's always of their parents, but it's not. A lot of them become caretakers of their spouses. We even have one that's a caretaker of an ex-spouse's parent. So this is just, it's a big topic in these days. Now, one of the other things as we wrap up that I see a lot of coming through is something that you and I shared conversation about, but we have a lot of our divorcee ladies that will inherit the majority of the debt.
Right.
And many times that's because they got the primary residence, and the primary residence ended up being the majority of the debt of the marriage.
Right.
But they only have half of the income.
Right.
And so talk to me a little bit about some things you've been able to do there.
So, most of the ladies want to stay in their home, and usually they are the ones that inherit the asset. But then what to do with that and the expenses from that point moving forward is stressful. It's one of the major concerns. And so the equity in the home they had to trade in the divorce, most likely, just like anything else. Well, that equity is their asset. But the logic that a lot of people follow is, well, we'll just keep the mortgage the way it is because that's my equity in the home. Well, you wouldn't take the diamond ring off your finger and go in the backyard and bury it in concrete. So why would we take the money that's in your home and leave it sitting there if it's not performing to the best of its ability?
Right.
And that may be pay the car off. That's $500 a month. Well, now you can afford the mortgage payment. And the $500 a month was only $25,000, so the mortgage only went up by $90 a month.
Right.
But you wiped out a $500 debt.
$400 more cash flow a month.
Absolutely.
Exactly.
Absolutely. All the way to the point that they got the house, and then maybe even they had the option to take the secondary residence. So what we did was we consolidated. Credit cards, usually maybe one will take one will take the other. Don't keep that credit card on that balance and strap yourself with that high payment. That is not the best utilization of the money. The best utilization is to put it together at a 2.75 to a 3% interest rate and get that monthly note that's on your burden off your back.
Mm-hmm. Well, thank you so much. I know you ladies, I want to share again, that's Shawn Kaplan, and thanks to everybody out here who's been listening. Thanks to our guest, Shawn, for joining us today. And Shawn, tell them how they can reach you.
Well, I would be honored to have a conversation with anybody or help offer any advice. The best way to get a hold of us is our team line, and that's what I love about your office is our cultures are very, very similar. I got a great team. I call my work family. But that number is 615-760-9121. And somebody's going to pick up the phone there and just let them know that, you want to have your mortgage refi analysis done, and we'll do that for you free of charge.
Oh, that's fantastic. And as always, if you got any questions about anything we discussed today, we'd love to talk to you about it more. I'm Jonathan Scott with Keystone Financial Resources. You can reach us at 615-661-9554 or at KeystoneFinancialResources.com. Thanks for listening.
You have been listening to Her Time to Retire with Glenn Price and Jonathan Scott. Glenn and Jonathan would love to talk to you and answer any of your retirement questions. All listeners can take advantage of a free 15-minute consultation with Glenn and Jonathan, whether via a phone call, Zoom meeting, or in person. You can schedule your consultation by calling 615-661-9554 or by visiting our website at www.keystonefinancialresources.com. Thanks for listening. The opinions expressed by Keystone Financial Resources and guests on this podcast are their own and do not reflect the opinions of this station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Investment advisory services offered through Brookstone Capital Management, LLC, or BCM, a registered investment advisor. BCM and Keystone Financial Resources are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents.